Bates, joined with Brian Wiley. We are fiduciary financial advisors here for you. We're in the depths of summer. We're officially halfway through the year 2026. And of course, my mind starts turning on. Okay, starting to see some Halloween decorations, some fall decorations hit the scene. Christmas will be here before you know it. Oh, yeah.
No,
let's get past this.
It's not pumpkin spice time. It is not pumpkin spice time.
But there's a lot of things that,
it's not.
Like in our financial world, right, where, you know, Brian, you and I have talked about this a lot of time, where a lot of times the focus is on market headlines or what this company's doing or this fancy IPO and what is SpaceX and is Tesla going to develop these humanoid robots and all of these around this the volatile nature of the markets and have I saved enough, all that. But a lot of times the main focus shouldn't necessarily be on a moving vehicle that you can't control. And we've talked about dynamics of the market. Volatility is a feature. It's not a bug. It's actually one of the ways that it's the main reason why you can build, accumulate, and maintain wealth as far as making your money work for you. But let's kind of zoom out and look at the maybe lower hanging fruit or arguably most important decisions when it comes to when you're making decisions on how you're structuring your business, how you're looking at the tax efficiencies of your plan. Because a lot of times you could just be making a simple checkbox selection on your tax form that is going to have dramatic implications in the short term and the long term. Or from a tax standpoint, maybe you should be focused on funding one account versus the other, meaning you're still achieving the main objective of deferring money, investing it, getting that long-term growth out of it, but just the simple election of what type account that contribution or that deposit is going to go into, that could likely have greater implications than the investments that you choose inside of that vehicle or inside of that account type. So today, Brian, I kind of want to bring this back to somewhat of the basics and take away some mysteries out of, especially for self-employed owners, or if you're looking to become self-employed. And Brian, you've probably seen this a lot on your end where, you know, I worked with clients where they have worked in the corporate world and then they branch off and then they're doing some level of consulting work, or they just branch off on their own and now they're adding employees as their business is growing. And it's one of the coolest things to see, this successful entrepreneurship that they are now on that path. But with that comes there's just more things that you need to pay attention to. And one of which is going to be your entity structure. Meaning, how is your business, and to be clear, this is going to be a separation of you and your business. How are you structuring and setting up your business as far as the eyes of the IRS, as far as your liability coverage? Because each one has different implications. Like, one thing that I see a lot consistently is when we talk about an LLC, a limited liability company. And my brother-in-law was up here. Love the guy. He was up here for 4th of July. We have this annual 4th of July family visit where my wife's two older sisters come out, their husbands, their family. So it's great. You get all the kids together. It's a little chaotic, but, you know, it's controlled chaos. It's a lot of fun. But we were talking, we're just talking shop, I guess you could say. And my wife's sister, she has a online retail store, so self-employed. And he just kept talking about LLCs. Like, well, if I want to do this, we need to do an LLC, and LLC this for the tax savings. Like, okay, well, you know, let me bring this back a little bit. The LLC has zero tax implications. If you set up your business as a limited liability company, LLC, and assuming you take the proper steps to where it's actually structured correctly, you got the formation documents, you have everything that legitimizes your LLC, proper state filing, EIN, all of that. Meaning you have significant proof and evidence that this business is separate from you as an individual. So you set up that LLC. There's zero tax implications that come with that. There's zero. Period. End of story. Just by setting up that LLC. How you
Wait, what?
Yeah, how you elect to tax it. And I think at this point it kind of lost on me. Maybe I had a few Coors Lights at that point. However, it just proves the point that like the general thought process is, hey, structure LLC, and all of a sudden I'm going to get tax savings, and that's not necessarily the case. It's those steps that you do above and beyond that of how you elect the tax filing of your LLC, or how you elect the tax filing of maybe, say, your partnership, and if you're going S Corp or C Corp, and obviously we can go over high-level overviews, but I mean, understanding the moving parts, and then if you like, ultimately, should you decide to do an LLC or should you decide to do an S Corp? And you can call the program because we are live, 979-59-MONEY. That is 979-596-6639. I'll give you a prime example where an S Corp election was actually incorrect, and I'll let you go, Brian. But had a client who was doing a lot of single family.
I'm here.
Single family rentals, and he was owning those inside of an S Corp, which again, there's some benefits to that as far as separating that income, saving on self-employment tax. But the big problem with that is he loses a step up in basis on those properties. The S Corp shares at his passing would receive an increase in basis or a step up in basis, if you will. And it's just a tax efficient way in our tax code where if you have an asset like a home, a rental property, or stocks for that matter, if they are owned by an individual and they pass away, the person that inherits that rental property, or that stock portfolio,
the S Corp shares, they get a step up in basis, meaning the value is now valued at the date of death, not when the first owner actually acquired said assets. So that's when you hear us say, well, yeah, if you pass away, step up in basis, there shouldn't be a tax obligation if that person who inherits it turns around and sell it. We get that. But the issue with owning that property, and it was a pretty extensive rental portfolio inside of that S Corp, is at death, there's no step up in basis on the properties. The shares of that S Corp get a step up, which again, if his spouse was going to sell the shares of the S Corp, but now you need to find a very specific buyer that wants to buy that 8 rental portfolio and inherit, potential liabilities that have been carried along with that corporation in the past. So again, thinking about these things as you structure extremely important, because I'm all for, hey, get started. Let's just keep the momentum rolling, especially if you're going down this self-employment path. But I do think there needs to be a little bit of forecasting beforehand just to make sure you're not unwinding some type of mess that you didn't intend to set up. So let's talk a little bit about the basics of this LLC versus the S Corp, and I'll explain some things with the basis point or your cost basis in a real simple way. My father passed away a little bit more than a year ago, and the custodian, in this case it was Edward Jones. I talked to the rep yesterday, and finally I was able to go through the portfolio, figure out how it was invested. And honestly, I gave him compliments on it. I said, you built that portfolio for exactly that man, because all the stocks that you just told me, they fit him. It was dividend-centric. It sounded like almost a dividend aristocrats type of a portfolio. But I'd asked him, I said, well, it's still invested now, yes? And yeah, and I said, okay, my dad died a little bit more than a year ago, so now I want to, when I go to move the value of those assets, I have an option to ask him to liquidate those investments, and I can move everything over as cash, or I could say I want it to be moved over in the assets that they're currently invested in, so then I can work when they're going to get sold and so on. And the reason why I'm going to do this is because now we're talking about 15 months since the date of death, roughly, which means all gains are now long-term capital gains if the date of death was used as the date that we are going to value each of the assets. Well, Edward Jones had already kind of elected that. They had already put it into the system. He said, we set up the basis for the date of death. And I said, okay, that's fine. Long-term capital gains, if you don't have a lot of income, long-term capital gains may actually tax you zero. If your income is below some marginal thresholds, which just figure if you're in the 12% tax bracket, you're not going to be paying any long-term capital gains. Well, I do have some intent to then move this over to my son, but there has to be something that has to occur first. I have to disclaim the asset officially in front of the court, never take possession of it, then be able to move it on to him, and I have to do it all at once before I take possession of any assets. Well, still the plan here, but the idea is that then I can move them over to my son. He'd receive those assets in kind, so the actual investments. He could sell them, no taxable gains whatsoever. Now, why would we even care about this? When you start looking at big numbers and you're thinking, well, gosh, let's say it's going to save you 5% federal taxes. Well, 5% of $100,000 is $5,000. Now, if you were trying to go out in the markets and you had targeted 10% annualized growth as your goal, what if you just right off the bat save 5% in taxes? So couldn't you in theory say, okay, well, I'm going to adjust my expectations long-term wise out of this portfolio now to adjust for that 5% I didn't have to go out there and try to earn. So you've got risk reduction as a result of tax efficiencies. That is how basis is calculated. So the basis would be, in this case, the inherited asset. What was the value of it on the date of his death? And then what did you sell it for and how long did it take? Well, basis, we're going to have more conversation about that when we come back. This is Real Money Pros. We are back. This is The Real Money Pros, therealmoneypros.com. That's how you find us, or you can call the program. It's a live financial program with fiduciary advisors here for you this weekend, right now, live, noon to 3 our time. However, it plays all around the nation, but it is a live program, 979-59-MONEY. That's 979-596-6639. Jeremiah Bates is here. I'm Brian Wiley. We sell advertising. That's really what this is about. So the Real Money Pros, if you notice, we've got sponsors. If you go onto our website, we have sponsors. Jeremiah's not selling you some insurance policy, some annuity policy. We're not selling you services. We're not selling you anything but advertising in good ideas. So the good ideas here are here on the program. The advertisers have been vetted out by us and our firm. We actually use these companies with our clients in our active practices. And now, our active practice, you'll have to find it. You go to therealmoneypros.com, and you can probably dink around in there, and you'll probably find a link that says Apollon Wealth Management or Tree City Advisors, and that's where we actively will work with people. But we're suggesting that people learn on this program. It's called The Real Money Pros. We're here with lots of different topics, and, of course, we're here for you if you've got a question. 979-59-MONEY. So we're talking about cost basis, and what I really want people to understand is how cost basis actually functions. So in a relationship, a married relationship, you get two step-ups. So you get a reset on how much the IRS will consider the asset to have been purchased with. You get a reset twice. So upon each death for a married couple, so that means that the kids, believe it or not, y'all think this, I got to pay taxes on mom and dad's inheritance. Well, unless the value of the inheritance is quite significant. Now, we're talking about over $30 million federally, and depending on which state you live, most states it's going to be well over $1 million if the state even has an estate tax. So typically, there are no taxes due upon inheritance. Now, I'm explaining kind of a unique situation, which is we still haven't settled out all this estate. It's been over a year now. The investments have been wrapped up. There's a court case, all kinds of stuff that's going on, and it's not very fun, but the point is that we've not had control of the investments. The advisor has, or at least he's had access to them. We've not been able to really see them. Now we're allowed to. And now that we're able to see them, we can distribute them. Now it's time to do some tax planning. And this cost basis issue is, in fact, an issue. And it relates, by the way, to S Corps and LLCs. And I'm explaining this because this is something you'll own. So the LLC, you're going to start that because you're looking for liability protection. Eventually, you're looking for tax efficiency. When you look for the tax efficiency, once you're starting to earn some money, you're going to want to talk to your CPA, your tax advisor, your financial advisor, figure out when should I switch the tax status of my LLC and have the IRS consider it to be an actual company, an S Corp. Otherwise, they're going to wash all of the taxes due through my personal tax return. That is why it's called a pass-through entity. Now, it still is, even if it's taxed as an S Corp, because it's going to go through, the net is going to come through your personal tax return, and it's going to then adjust where you are in the marginal tax brackets and so on. But with the LLC themselves, you won't get the benefit of being able to take some of the, I guess, your profits or your dividends as a dividend, meaning you don't pay FICA taxes on that portion, but you're actually receiving it as if it's just regular investment income. And then you may receive some of your income as an employee of the company. So this is where you're a W-2 employee, maybe a 1099, but nonetheless, that's your employment work for the company. Some of it's just as a shareholder. That's the S Corp. Some of it as the employee. That division saves people thousands of dollars. But when you're not getting a lot of revenue in, the cost to set this up, maybe your consistency is a little unsure. You want to make sure this is a permanent change that you're going to go through. But when you do it, you do it. You commit to it, and it opens up the opportunity for you to save more money in your retirement accounts, to save for your employees, to have additional layers of liability. But the initial filing for the LLC is great training to get you started. Make sure that you go through all the steps, though. Get the book, all of it. Fill out the book. Make sure that you've got an operating agreement, a shareholder agreement. buy-sell agreements. Work with an attorney would be the best case, in my opinion.
Well, with the LLC, kind of what we were speaking to is that it does serve a purpose. Meaning, if you're just looking at an LLC on its own in a vacuum, the real intent behind that is to give you liability protection. Meaning, you have your endeavors as the business. And I think this is an important thing to note. Even if you view yourself as the guy, the gal that is the business, you want to almost start changing your thinking around, no, I have me and all my personal stuff, like my home, my personal car, my art, whatever the case is, right? Those are part of you that have really no function within the business. So you really want to start looking at these two things separately, because let's imagine that you are, I don't know, you're laying pads of concrete and you do something incorrectly and then someone stubs their toe, falls, and breaks an arm. I'm just putting this thing up totally hypothetically. And they say, hey, that guy who laid that piece of concrete, we're going after him. We're going to get litigious, if you will. The idea behind the LLC is, okay, that work was done by the LLC, not personally. So if they are going to try and get litigious and maybe sue me for this and that, the medical bills, and then they're looking at everything that's owned within the LLC, they can only look what's inside of that LLC. They can't look at the value. Again, this is assuming that the LLC was created accurately. Like, there's true evidence that there is separation. Like, you have your own books, there's your own tax filing, you have your own EIN, there's a separate bank account, like everything's separate. You have the books as far as the operating agreement, buy-sell agreement. So if they were to look at your LLC, it's like, oh, no, this is legitimate. This is true separation of company versus personal. So it's that liability protection. From a tax standpoint, now, Brian, to your point, this is where you look at, okay, is it consistent? Am I getting enough net revenue from the business to justify electing as an S Corp? Because that's the kicker, right? When you're an employee, if you're working for a company, you pay into Social Security, Medicare, aka payroll/FICA taxes. And as the employee, you're paying 1/2 and the employer pays 1/2. Well, when you're self-employed, guess what? You're the employer and the employee, which means you're paying both sides, which is what, 15 point, a little north of 15%, 15.3%.
15.3.
15.3. Yep. So the idea of the S Corp is, okay, if I'm getting enough net profits and I can pay myself a wage, the W-2, which I know there's a lot of different methodologies in which you can arrive at how much you would actually pay yourself as a wage. But generally speaking, you could look at what's the going market rate if you were to replace yourself. Meaning, if you were going to hire someone to do like the actual job that you're doing, what would you pay him? Then that could be deemed as your W-2 wage. That is the amount that's subject to the payroll tax, aka self-employment tax. And then any net profit above and beyond that is you're taking as an owner draw. Yes, it would pass through to you. You would pay federal income tax. You would pay potentially state income tax, depending on what state you live in. But the idea is that hopefully a good portion within reason is not subject to that 15.3%. So that is the rubber hitting the road of how can you actually arrive at thousands of dollars of tax savings by electing an S Corp. That's actually how that functions. But you don't just want to go very light on the W-2 that you pay yourself, because there's deferral into retirement accounts that need to be taken into consideration. There's Social Security, paying into Social Security that needs to be taken into consideration. So it's this kind of whole ecosystem that comes together that you should have in your purview about how you actually structure S Corp, LLC, partnership, all that.
A lot of gains that have been happening in the markets here recently, and some losses now. So what do you do when you've got nice gains in some sort of a stock that you want to keep? Is there a way to protect it? We can talk about that a little bit later in the program. This is The Real Money Pros. Go to therealmoneypros.com. Jeremiah Bates is here. I'm Brian Wiley. Fiduciary-only advisors available to you right now on the phones at 979-59-MONEY. This is The Real Money Pros.
Holland Wealth Management. And we're back. Welcome back to The Real Money Pros. TheRealMoneyPros.com is where you can find us. Listen, if there's one thing that we really try to put across on this program is good financial decisions do not happen by accident. Whether you're structuring a business, whether you're finding the right allocation within your accounts as far as what do you hold, what do I buy, when do I sell, how do I put together a proper retirement cash flow plan that encompasses my goals and the time at which I need to do that withdrawal. How do I be tax efficient? How do I avoid IRMA charges? How do I forecast RMDs, required minimum distributions, and are there efficient ways that we can tackle these? Meaning, those good decisions that are all efficient, they don't happen by accident. It takes a plan. It takes coordination. It takes someone that you know is in your corner that has experience in this realm that can help guide you, not sell you, guide you. And I also say this, bad financial decisions also don't happen by accident either. Sometimes they're just, it's out of sight, out of mind. You know you should be doing something, but you continuously kick that can down the road. So stop kicking the can down the road. We have a network of advisors across the country, fiduciary advisors that can help you. Go to therealmoneypros.com, click on Find the Advisor tab, and we will get you connected with an Apollon Wealth Management fiduciary advisor that can help you in your situation.
On that note, I want to bring up a conversation that I just recently had, which is, I guess there's an image that people would have of financial advisors. And I kind of went through it and explained it to him. And I was asking him more how he was paying his advisor. He wasn't sure. Bottom line is we kind of determined that it was a commission-based relationship. And whenever the advisor would trade something or buy a mutual fund or something, he'd be compensated at that time and not as a fiduciary. Well, the fiduciary role is pretty important. Think about it like your doctor. Your doctor took a Hippocratic oath to do no harm and to do what's the best interest of you. And I was talking to the same friend about this, and I said, if you think about it, I said, as far as I'm aware, a pharmacist or a dentist or, I don't know, give me some other, a chiropractor, I don't believe that they actually take the Hippocratic oath. Maybe they do, maybe they don't. I still think that they're still bound by the same terms. But if you think about it, oftentimes you walk out of their office and they're trying to sell you the stuff that they just suggested to you. It's like a membership at the chiropractor, and next thing you know, you got a toothbrush from the dentist, and you're buying glasses from your eye doctor, and so on. And I always question whether or not there could be a conflict in that advice. Like, oh yeah, you need glasses with really light, the prescription in them, and you got to wonder, do I really need them, or does this guy just need the sale? With the financial advisor, ask those same questions. So I had a friend of mine that was here in town last week, and he had inherited a lot of money from his dad, and he's always worked in the company that his dad had run. He was one of the laborers. He'd be out there. He works with the crews, and now he's at the helm of the company, and he has a sister, and he has a living mother, so they're in essence managing the company on the behalf of the mother until she passes, and then they would sell or divide up the company and so on. But he and his sister are a little bit at odds at times about the running of the company and the long-term objectives. She really wants to sell it eventually, be able to just cash out, and be out of it, but he's got the passion of the family business, so he wants to keep it. And it turns out that her husband is a financial advisor, and he manages the money. And I said to my friend, I said, well, it could sound like self-interest. Yeah, I'd be happy to manage this money for you. It's a lot of money. It'd be a great payday for me. He's a great friend of mine. I think that we'd do a great job. And so this could sound like very conflicted advice, but you should probably get your money away from your brother-in-law at some point, because you're going to be negotiating with them about the value of the company, and you might start nitpicking each other. And all you need to have is that comment come saying, well, we know how much money you've got inside your account. It's leverage for a discussion. And from that reason alone, I just said, just make your life a little bit more private. I said, you don't need to make it like, abrupt. You don't need but think about the conflicts that are in it right now when they can see all of your financial position. It puts him at least at a disadvantage in the conversation about what to do to dispose of the company or however it's going to go. When you're looking for a financial advisor, look for somebody that's not going to have the conflicts. I had another conversation with a friend yesterday. He was telling me, he goes, my financial advisor says, I've only got $250,000 in my 401k, and I've got to save, I've got to have 4 times that amount when I retire. And I said, well, what did he look at? And he says, my account. And I said, only the account. I said, so he's looking at your monthly expenses. So he's not incorrect. He's just incomplete is what it is. He's incomplete. I said, how is he paid? He goes, commissions. And I said, okay. He really only cares about that one account. He doesn't care about the whole picture because he's not got that fiduciary contract with you to know everything about you, to make sure that the suggestions inside your 401k fit every aspect of your life. And here's where I said that they don't. I said, did he ask you about your Social Security benefit, your income, how much you're paying into it? Did he figure out that you're going to earn the maximum Social Security benefit? Did he know that your mortgage would be paid off in 7 years? Did he know that you're dumping an extra $2,000 a month toward the principal? No. And I said, so he also didn't calculate your Social Security. And I asked him, I said, could you live on $4,000 a month? He goes, yes. I said, how much are you living on right now? And he says, well, we kind of deducted it. We figured out without the mortgage, he was going to save about $3,500 a month. And I said, look, your 401k or your 401k is kind of not really there because you're going to need it. It looks like your Social Security payment will make it if you can wait till full retirement age. And I said, so you got two completely different answers. And I told him, I said, your 401k should be invested. And it should be invested like you've got at least 7 years, just like it is. And I said, so it needs to be in growth stocks. And it wasn't. In fact, it doesn't have much in growth at all. It's mostly money market and these time-based funds, which are not suited for that individual person. And so while the rule of thumb is sometimes good, and sometimes it fits the advice that you're being given because it's easy, look for the difficult advice, the difficult answers, the difficult strategies, whatever it's going to be. It's just the truth. That's what you need. 979-59-MONEY. It's a phone line here.
And you can send a text message to 979-596-6639. I want to go to the text line right now. We actually got a good question kind of in regards to this S Corp conversation, structuring the business. Says, I own a roofing company structured as an S Corp. It's just me. I got a business truck, some equipment. My wife the other day asked if I got hit by a bus tomorrow, what would happen to the business? And he says, honestly, I have no idea. What should I have in place to make sure that essentially the sentiment is smooth transition of the business that he owns, and how would his wife be able to basically unwind it? And this is kind of a common discussion that I have with business owners, where generally it's one spouse that's at the helm of the business and the other spouse is taking care of the kids, running the household, like really not hands-on. And a lot of times the business documentation reflects that as well, meaning let's just say it was an LLC and he's filing it as an S Corp. Only one person's name is on all those corporate documents, on the business bank accounts, on the business credit cards, the invoice. I mean, really everything, it's by that one spouse. So it is a great question is, hey, if there's an unexpected or an accelerated expiration date by the business owner and it's a part of the estate, how does that surviving spouse continue that business on legally or have the actual legal authority to dissolve and actually unwind the business? And there's a lot of different ways you can do this, by the way. Brian, you can add into this, but it kind of goes along the lines of having appropriate corporate documents, meaning in your operating agreement, your buy-sell agreement, meaning you can have that actually listed out. I think a big one of the lowest hanging fruits, in my opinion, is if you have a living trust, a revocable living trust, meaning it's set in place to determine where your assets go upon your passing, or if you and your spouse pass away. You can assign your revocable living trust. You can assign the interest of that LLC or S Corp to that trust. So while you're alive, the trust is just an extension of you. Everything's reported on your Social Security number. You still control it, all of that. And where that living trust really hits the road is when you pass away. So you're to pass away. If that trust is assigned ownership, well, that doesn't change. The revocable trust still has ownership. And now who's in control of the trust? Well, before it was you and your spouse, now it's just your spouse. So that just single connection right there brings it all together where your spouse can then dissolve it, can carry on the business, work with the proper entities and authorities to say, hey, this is the final tax return. I have the ability to sign on this final tax return. It just takes away a lot of friction. Yeah, there would still be some legwork, some groundwork that you got to cover to actually get that done, but you avoid a bunch of hurdles if you just have a connection, like proper connection with your business planning and your estate planning. Or if there's no estate plan, let's just say you have a will, then accounting for that in the will, and then also having that in the corporate documentation so it allows for smooth transition.
So you got to think about how contracts work, and I'm often asked this question when people are asking me about selling a business or something on it, and we talk about different ways to craft up the deal, and their answer is that legal? Like, well, yes. In fact, here's the way it works. A contract is legal when two parties accept it, and assuming that all the provisions within the contract are legal, meaning you're not asking the person to do something illegal. You can tell them everybody here has got to wear red shoes, and that can become a rule if everybody agrees to it. They sign the paperwork. That can be a rule, and it can be enforceable however you want to decide to do that, but it's free form. That's how the contracts work. So think about it this way. When you are drawing up your corporate documents with the LLC, it would not hurt for you to write a personal line in there that you just put in some sentences saying, upon my death, I want all my shares to transfer to my trust or to my wife, and put it into your trust. All those shares should come in, or the membership interest. This is Real Money Pros. You've got questions, we've got answers. We'll be right back.
We are back. This is the Real Money Pros. Again, we are live. Phone lines are open. Interact with us. You got questions, we got answers. You want to change the topic? You want to talk about high-flying tech stocks? This AI continuing? I read this interesting article of Tesla. I think it was in Fremont, California, that they had earmarked for Tesla, fabrication, like construction, if you will, that they're going to change that assembly line to start rock and rolling on those humanoid Optimus robots, which not to throw this little wrench in there, but I am highly optimistic on these robots. Not necessarily saying that this is going to translate to some huge investment opportunity, but I do think that if you look at human nature, the rate of progress, research and development, where money is flowing, and kind of these sectors or categories, if you will, where it's like, where do we go from here? I do find that the automation side of things, the AI side of things, and the use of robotics, I find it highly intriguing. But bottom line is, you want to chat about it, call us 979-59-MONEY. You can also send us a text message, 979-596-6639.
All right, I talked about how protecting a stock, or maybe you got gains. So I'll give you the example. I had bought Micron when I had said last year, you might want to consider Micron. I said that to everybody here, and I bought it about a week later. I had a $70 cost basis. The stock is trading at $980 roughly, closing yesterday. And then it traded as high as about $1,240, I think, after they came out with their earnings. So it's down significantly. If you really look at that, that's a significant decline, down to 980 from 1,240 roughly. But I still like the stock long term. In fact, do I care that it went down? Sure, because now I'm looking at opportunities. So when it was at 1240, you could look at ways to protect it from a significant downside, which might be buying an option contract. So talk to your financial advisor about strategies where you may be able to protect them. And here's what I am actually doing, which is I bought some puts on Micron. I bought some calls on Micron. I did this to surround the earnings date because all I knew is with the emotional investors that are behind the Micron purchases that they've got huge gains in it, or they just got in and now they're concerned about having losses, is I do know that the stock probably wasn't going to stay close to its price the day they were going to come out with their earnings. Either it was going to come out great or bad, and the market would reflect probably an overreaction to either. So the call and the put seemed like a good idea. Obviously, the put became very in the money. In fact, it had made big gains. And my idea there was sell them and buy more Micron stock, because that was really what I was after. The calls, on the other hand, went down in value. And the idea for me there was I was going to take some of the proceeds of the put, and I was going to then buy more Micron stock, and then I was going to bolster my call position because I still look at a rebound, in which case when the rebound happens, the call should go up. I should be able to sell that, take those gains, maybe buy more Micron stock, but the reality is I'll probably then buy more puts to be able to protect it. This is a way you can actively manage a stock without selling the stock. So I'm protecting my cost basis. In this case, it's in an IRA, so it doesn't really matter, but had it been an unqualified account, this would have been a great way to protect the cost basis and to not take a gain when I didn't want it, but still have protection techniques employed. We can do this with just about any stock. So even the flat ones, the ones that are paying dividends, you can look at strategies on how you can protect them or even earn something when they're flat.
And I think when you look at these I'm going to use jargony terms here, this high concentration, meaning if you look at all your investments, and Brian, like in your case, let's imagine you bought Micron back in, 2018, 2019. You're probably up close to 2,000%, maybe a little bit less, but well over 1,000%. And you look at it through a few different lenses. It's like that protection piece where, again, if you're looking at it bullish long term, but what I think is a helpful practice too is, what if the stock dropped 50%? How would you feel? Is it well, man, this stock now represents such a high percentage of my overall investments, meaning maybe not all my eggs are in that one basket, but this one egg is clearly bigger than the other ones. It's like an ostrich egg compared to the chicken eggs. If you're in that case, then those protection techniques where you can use derivatives, you can use the option side of things to either generate income through covered calls or putting puts in place to where if it was going to have a dramatic drop, you have that price where things will take place, meaning you're forecasting, like you have a strategy in place versus just being at the mercy of potential whipsaw movements of that stock. But then there's also the flip side too, where if majority of your liquid resource, and the reason why I say liquid when you're looking at a stock market, like a publicly traded investment, meaning it's liquid. You can go click a button, put in a market order, and that cash will generally be there next business day or 2 business days. Not like a rental property, a piece of real estate. Like there's no button you can click where immediately it's sold and now you have access to that liquid cash. So now if we're looking at liquidity, meaning, well, geez, yeah, on paper, my net worth looks great. On paper, my retirement looks great. But now I'm running into issues of how do I actually access that? Like, how do I turn that stock that shows great gains into like viable economic impact to me and my family? And that's where you got to dive a little bit deeper. It's like, okay, what are the tax implications? And sometimes the right answer is, yeah, just pay the tax. I mean, understand what the tax is going to be, like in coordination with everything, so you're not surprised. But I had this conversation with a client a few weeks ago, and he was just so hung up on like all these ancillary things, like, well, what about the IRMA and what about the net investment tax? I'm like, give me a week and I'll forecast this all for you. And we did. And I said, here's the numbers. Like, is it terrible? Does it take you away from wanting to sell this stock? He's like, no. I'm like, exactly. Take my advice. Liquidate it. You got a bird in hand, and now we already have the tax forecasting done. So when you actually file come, April of next year, we're going to know exactly, like we're going to have all the liquidity aside, so you're not just left getting kicked in the shorts from a tax standpoint. But sometimes the answer is not selling. Sometimes the tax bogey is extensive enough, or there's other situations going on. But there are ways, again, through various option strategies, through using security-backed lending, where you can actually you can get access to liquidity that, oh, by the way, it can be tax-free and sometimes tax-deductible, where you can still maintain that asset, but also tap into a way to get liquidity off of it to do the things that you want to do. So you're not just staring at this scoreboard that's giving you points in the form of that stock going up or down.
You can also consider working within the rules of the wash sale rules. So if you wanted to sell let's say that you had an AI stock of some sort, maybe it's, give me one. CoreWeave.
Yeah, CoreWeave.
Okay, let's say you had CoreWeave and you're happy with it and you decide that you wanted to take your gains on it. So you take the gains on it, but you're thinking you still want to stay in that industry, and you decide that you're going to buy, let's say, an ETF that follows AI instead. So you do that, and you're going to probably pass the test. You should be able to pass the test because it's not the same kind. It's actually not the same investment. It could be the same industry, but it's a very different investment. And so you should be able to qualify for that. You would take the losses or the gains. And what I'm talking about is actually having a tax loss harvest strategy, which is, if you're going to take the gains on something, do you have something else you can go take some temporary losses in, maybe even switch those investments to something in the same industry, still get the exposure that you want without any great impact, but be able to pick up the tax benefits. And by doing this, it goes back to the same conversation I had yesterday with my friend with the 401k. I said, it's just your hands are there. You're not in the controls constantly, but instead you're monitoring it, and you're doing things that will be that can actually make significant differences over the long run. So in this case with Micron, what I'm sticking to is my commitment to the long-term bucket. And if you don't understand the better buckets, go to therealmoneypros.com, and it is a commitment. And the reason why I say this is we've created that system to be visual and functional. So it starts with planning, it goes through cash flow planning, and then it becomes visual with the buckets to help you understand why you're invested the way you're invested, to take your hands out of the controls, to allow it to just do its thing. So in my case, I set that money aside for longer than 10 years. And so if I were to go in there and say, well, I'm concerned I need to rebalance, I may rebalance myself out of all future opportunities because I keep trimming out the good opportunities moving forward. And I do not believe that AI is done. I don't believe that we know enough about robotics. I do believe that there are a lot of people in those industries that understand it a lot better than we do. And there's a large ramp up going on because they believe that consumers and industry are going to be buying these products. And I want to be a part of it.
10 seconds.
Phone lines are open, 979-59-MONEY. You can contact us. Go to therealmoneypros.com. Second hour's coming up. Jeremiah Bates is here. I'm Brian Wiley. This is The Real Money Pros. Stay with us. Every other confusing money topic made simple. That means we get to skip the ones that are confusing because we're every other financial topic. Well, this is The Real Money Pros, therealmoneypros.com. That's how you find us. Jeremiah Bates is here and Brian Wiley. Your weekend live financial program. If you want to talk money, you want to talk about the markets, we can mix in politics, which I plan to do here in a moment, kind of, geopolitics. Geopolitical issues, which is our war with Iran right now. But what are your thoughts? Do you have questions? Do you need some help? Do you got some ideas that you need tossed around? Do you have some tax issues? Do you have an estate question? Call 979-59-MONEY. That's 979-596-6639. You can text the same number. You can use our website and send us an email or ask the experts right there on the front page. And again, it's 979-59-MONEY. But with what is going on in Iran, and of course we're watching on a daily basis, which now we've got have we officially said that the ceasefire is over? I think that President Trump said it, and I think now Iran has now confirmed it. Sounds like, again, loggerheads on trying to make a decision on what we're going to do. Whether you think we're going to come out better or not, or what the result is going to be, good for the United States or not, what are you going to do about it investment-wise? And as I've talked about this for quite some time, is that a lot of the answers on what to invest in is taking a step back and understanding the behavior of the markets themselves and who's investing in it and what they're doing. I gave an example earlier, which is there's a lot of amateur money in Micron stock right now. A lot of people have bought that stock hoping to get big gains, which means they're probably not going to make the most professional decisions on when to get out or when to buy more. And that's the reason why we see this hyperactive volatility that drove the stock down more than 20% in a week. What do you think is going to happen with Iran? What do you think is going to be the outcome? And when will it be? Because if you said, okay, it's going to be sometime in the next week, then I'll give you the forecast, then we would expect crude oil prices to start to settle even a little bit lower, but probably not significant because it seems like it's already priced in that it's coming. But then you've got companies out there that are still paying the higher oil fees and don't really understand what's going to happen in the future. So then it really affects their bottom line and the forecast, such as cruise lines, airlines, and so on. If you thought it was going to end pretty quick, then why wouldn't you look at certain companies that have been really beat up over this particular issue, knowing that the resolution itself should quickly improve the finances or the forecasts of the companies that you have in target? So, or as your target, not in target stock. I don't know about that one right now. Call the program and let us know, when do you think it's going to be over? What do you think is going to be the resolution? Do you think that, okay, so let's say Iran's going to have some sort of control over the Strait of Hormuz. They're going to have some sort of passage fee for ships that are going to go through. If that ends up being the case, then oil prices are still probably going to stabilize. It's really about the resolution. Even though we're upset, we don't like Iran, or we're mixed about the whole thoughts about the fact that we're at war with Iran. Let's look at it from the investor behavior standpoint. What are your thoughts? When's it going to end? And if that's the case, I'll tell you what I think you should invest in. Just give me the forecast on when do you think it's going to be over, and you can say the dust or the sand has settled over the Middle East, and it seems to be somewhat stable over there. It looks like, Israel is making some accomplishments with their targets on Hezbollah and Hamas. It looks like Hamas is now disbanding, or is it Hezbollah? Not Hezbollah, I think it was Hamas. And I think there's going to be a lot of conversation about Israel, but it may not be more destabilization of the Middle East itself. But what are your thoughts? 979-59-MONEY. Are you getting a lot of client conversations about this right now as well, Jeremiah?
Not as much. Because I think it's just been the same playbook really over the past few months, like really since this conflict started, where you hear some commentary, you hear a plan, and then there's a market reaction either to the upside or the downside, meaning there's optimism that, hey, based on this commentary, sounds like we're going to get a quick and speedy resolution. And, arguably you've seen that with where futures have been pricing in oil prices. You have you have futures pricing in price per barrel, at least for WTI crude, at least for December 2026, around $72 a barrel. Now, that wasn't necessarily the case a few months ago where we saw oil prices rise dramatically because there was concern. Because the concern was, okay, this thing's going to be drawn out, it's going to be long, and we just really been seeing this whipsaw of, okay, it's either going to be resolved fast, and then we see that reflected in oil prices. Then we start to see this movement in other sectors or other stocks that are more sensitive to the swing of oil prices, right? So think, your airlines, your cruise lines, those have been some of the biggest wins and winners and losers depending on the news that breaks, right? So then there's optimism around, hey, we're going to get a deal done. The Strait of Hormuz is going to reopen. There's a ceasefire. Like, we're going to finally arrive at an agreement. And then fast forward a week or two, and it's, okay, no, they've attacked. There was an assault that was done by Iran. They, this and that, and then, okay, the ceasefire's done. Now negotiations have stopped. President Trump makes a comment, okay, I'm not willing to have negotiations. The next day, I am willing to have negotiations. So the market's trying to get a bead on it, but you're seeing these point-in-time reactions on it. But overall, I think the reason why this hasn't been such a cause of concern, I guess, with clients and not really having to feel, the conversation will come up, but it's not like I've been getting calls of like, okay, what's the deal here? I think, with all the news coverage that's on here, you kind of get that it's a developing situation. But to your point, when we talk about pricing in, there's two things that I'm really looking at that are more sensitive to this. It's obviously the oil markets. We're futures pricing in oil, and we can see right now that it's not too concerned. If we were looking at $80, $90, $100 a barrel, okay, then there's clearly the markets are seeing something that are raising a bit of a red flag, and we're just not seeing that right now. And that's despite those recent developments that have happened over the past couple weeks. But what I do find interesting is the 10-year Treasury yield. So the 10-year Treasury yield, we're looking at the fixed income market and really the information that we can gather on that of where they're forecasting inflation, where they're forecasting interest rates. That gets a little interesting too, because now we have the 10-year Treasury yield back above 4.5%, and we've been seeing this it trickling higher really over the past week. And again, with these Middle East developments, if there is the expectation that oil prices will stay elevated, gas prices will stay elevated, and there's other categories of fixed costs from the U.S. consumer that is directly affected by the price of oil, and it's not just at the pump. You look at food, you look at all these staple items that people need to purchase. Then you see the bond market saying, okay, maybe we're not going to see inflation start to trickle down. And obviously, we look at the Federal Reserve now with the new sheriff in town, Warsh, and he's making adamant like, hey, we're done doing this forecasting. Like, yeah, we'll do the dot plot, but I'm not going to do Q&A to give you some insight into what where we think the interest rates are moving. And he's been very adamant about that. But I think what the 10-year Treasury yield is telling us, the bond market, is that, yeah, inflation may be a little bit stickier, and those interest rate cuts that many had anticipated taking place at the beginning of this year, that's really no longer in play. You have a lot of Fed Reserve members on that most recent meeting. They're advocating for actually rate hikes, which could be really interesting to see that effect on fixed income, which then could affect, the depository rates with CDs, with your money market accounts. So again, this back half of the year could be interesting. But then again, with the Middle East development, it's hard to get a beat on, not to sound redundant, but 1 week it's like, okay, we're getting a resolution. And the next week it's like, geez, things are really escalating at this point. And I think it's anyone's guess at this point. But certainly from a market standpoint, you're going to see certain stocks, like I said, like cruise lines, airliners, a lot of times those have gotten beat up. Like I saw Delta, Norwegian, those stocks were getting hammered at one point, really at the height of this conflict.
50%.
Really, people couldn't get a beat on it. And then when there was that resolution, you saw this bump back up. So it kind of goes to your point, Brian, where if you feel that, we'll get a resolution to that. Well, if that it really is the mindset, if it'll happen sooner rather than later, then there's certainly some opportunities that these companies are just getting beat up because they're just more sensitive to what the price of oil is doing.
Well, there's some logic behind this whole thing, too, because if you watch the track record of President Trump, his first time in office and now his second time, he's very consistent on making sure that he pulls it back into good economic prosperity. So right now we've got oil companies, which look great if you own them inside your portfolio. At least they did for a while, especially when the war had started. But you notice that the prices have come back down. Any pressure on consumers will not bode well for these oil companies. And second is there will be a resolution to it. The world is demanding it. And it's also necessary, but there could be some other fallout that actually might be positive if you're thinking ahead of time, because you might want to start looking at alternative energy at this point. We just found out how dependent the entire world is on the Strait of Hormuz, and if it's not controllable, if it's not agreeable, then there's going to be a push for other ways to supply our energy, and it may not be for the green reasons. It might be the other green reasons. This is Real Money Pros.
We are back. This is the Real Money Pros. We are live. Phone lines are open. 979-59-MONEY. You can send us a text message as well. That is 979-596-6639. Visit therealmoneypros.com. Sign up for our newsletter. And again, if you're navigating retirement, trying to navigate tax efficiencies, trying to navigate investments, these good decisions that maybe you've made, probably not happening by accident. Or maybe you got some friends or family members where you just look at what they're doing and you're like, dang it. Like, how are they doing this? Generally, the right guidance matters. I mean, you want clarity around your financial future, and getting connected with a fiduciary advisor can certainly help. One that is experienced, one who you know is in your corner, working in your best interests. So again, visit therealmoneypros.com, click on Find the Advisor tab. We'll help connect you with an Apollon Wealth Management fiduciary advisor who is a good fit for your situation. Also, realmoneypros.com, it's where you can get our podcasts. It's where you can get our educational content. We try to put as much education out there as possible, because the more educated you are, the less you need to consume yourself with the uncertainties of where the market's going today, where the market's going tomorrow, what's happening with oil prices, right? I mean, obviously we don't want to be completely, head in the ground when it comes to these things, but when you're more educated, you can understand the cause and effect of these situations and how does it actually apply to you. So then you can filter through the noise of, okay, is this something should I actually pay attention to? And then based on this, should I actually make adjustments to the overall plan? Or no, this is just a point in time event and we've already really accounted for this, so we can just keep it moving and not really have to concern ourselves with it. And you can go back to what is actually moving the needle as far as the gauge on your quality of life and impact of spending. So again, visit therealmoneypros.com. You can send us emails, Jeremiah at therealmoneypros.com, Brian, that's BRIAN at therealmoneypros.com. You have questions, we have answers. I did actually have a question come through via email, and it was around these qualified opportunity zone investments. So bottom line is, qualified opportunity zones were part of the Tax Cuts and Jobs Act, where if you recognized a large capital gain, maybe you sold a business, maybe you sold some property, maybe you sold some stock, you could then take that gain. Let's just say it was a $1 million capital gain that you were looking at. You could take that entire gain or a portion of that gain and invest it into a qualified opportunity zone. And the real idea of that is the money was being put in these real estate and development funds, if you will, to help spur economic activity in maybe some downtrodden areas. That's really the idea behind it. And in doing that, you're able to defer that capital gain, which expires December 31st, 2026. So basically what I'm saying is this: if you put money into a qualified opportunity zone, it is going to be as if you recognize that capital gain December 31st, 2026. And the question that came via the email is, hey, I put money in this qualified opportunity zone. I understand that gain that I deferred is now actually going to be recognized in 2026. What do I need to do? Like, do I need to coordinate with the IRS? Like, what actually steps do I need to take? And really, there's nothing you necessarily need to do in preparation with the IRS, but the fact that we have a lot of runway for the rest of this year, you want to get on this sooner rather than later, meaning understand what was the actual gain that you deferred in that year you entered in that qualified opportunity zone. And that'll be reflected on the tax documents that you filed in that specific year. So let's imagine you went into it in 2023. Get your tax return from 2023 and see, okay, what was the amount that was deferred? So, or if you worked with a tax professional like a CPA, get with them and say, hey, we need to get ahead of this. So you can understand what is the gain that I'm going to recognize and how is that going to affect everything else that happened in this year. And that's going to be important because if that tax bogey is going to be very surprising to you, you can look at various ways to potentially lower that. Or maybe you hit the mark where that year that you deferred the gain, it was high income, and now this year is a low income, and maybe that tax bogey isn't going to be as extensive, so then you just pay the taxes. But bottom line is you want to be prepared for it, understand what it's going to be, and then if you need to look at various strategies, you have time to implement and you have time to execute these. So to answer that question directly, no, there's nothing specifically you need to do to necessarily get in front of this, but logistically how this is going to work is your 2026 tax return is going to reflect you recognizing that capital gain that you deferred in that qualified opportunity zone. So the key is see how that's going to affect your overall tax picture and make adjustments as needed. Again, Real Money Pros.
So I have a question.
Oh, sorry, go, Brian.
I've got a question for you on that, which is, so the opportunity zones obviously offered out to people to be able to take some gains that they had something else and be able to defer them out, just like you would do with the 1031 exchange.
Correct.
The 1031 exchange requires a like-kind investment. So imagine a rental property, you're going to end up buying another rental property, but had this money been coming from gains that were completely unassociated with real estate or trying to fix up a small community or a neighborhood or whatever it is that you're going to invest in, that's what this was enabling, right? Is access to be able to have similar benefits. So the idea here would be to, in a married situation, is to basically 1031, as we would say, to death. So then you get the step up and then you don't pay the taxes on these at all.
Yeah.
That is wild to people. I don't know if people really understand that, is that there are no gains ever paid on these type of investments if they're held until death. Mm-hmm. Then they're inherited, and then that person receives them, can sell them immediately with no gains taxes. And I know that this surprises people, but this is how the step-up in basis works. And again, you get 2 step-ups in a married situation. So if you got questions about that, call us 979-59-MONEY. That's 979-596-6639. But you can't be squirreled into this idea that a qualified opportunity zone is a fix. If you're already in a similar type of investment, you might want to consider not doing the qualified opportunity zone. It may complicate your tax return for something you ultimately don't even actually need or plan to pay those taxes on because you're planning to hold those until one of you died. Well, it's kind of a weird concept, but that is an honest conversation to have with people.
No, so it is, and that's the old adage with these 1031 exchanges, right? Where the best way I can describe a 1031 exchange, at least how we've executed a lot of times, is clients got a pain in the neck, kicking the shorts rental property that's taking up their time, it's taking up their energy, and they're just annoyed. And we'll run the analysis on the actual economic impact of them as far as the cash flow from these things. And a lot of times it's not as pretty as you really think. Especially, I would suggest that you go through this practice if you are a rental property owner. Look at your past 5 years, maybe even go back 10, and get an average of what that actual annualized cash flows to you from like your cap ratio or the equivalent of a yield, like meaning that value of that asset, what is actually producing for you as a percentage of income based on that value. And more times than not, I'm painting with broad brushstrokes, more times than not, it's pretty low. So if you factor in it's kind of an underperforming asset as far as an income producer, it's a pain in the neck as far as you having to manage it, and you're just annoyed and you want to simplify things, that's where that 1031 exchange can allow you to, because if you sell it, you could be running into a big taxable gain. And if you don't want to recognize that, you can maybe go find another like-kind property that's maybe newer,
30 seconds.
Less maintenance, less riffraff as far as the location that it's in, and then you can roll those funds into that new property and not have to pay a cent in capital gains. It's a good option.
Do you think it's fair that you would receive tax benefits if it's real estate but not a stock? Because you can't do the 1031 exchange on the stock. So the stock has no preference. How do you think all that happened and made it through Congress? Do you think maybe there was a lobby from wealthy people or people interested in real estate? Yep, that's how it happened. This is Real.
We are back. This is the Real Money Pros. Jeremiah Bates joined with Brian Wiley, fiduciary financial advisors here at your service. We are live, so you can interact with us. Give us a call, 979-59-MONEY. Send us a text message, 979-596-6639. I want to get to the text lines because we did have an interesting question coming in around. It was more around the conversation that we were having around business structure in the first hour. So if you missed that first hour, go to therealmoneypros.com. That's where you can pick up our archive shows and our podcast. But I'll summarize this question. It comes down to, I spent 30 years building my business. My kids now have careers of their own and are not interested in taking it over. I assume that someday they would. Don't really know what my options are right now. How should I consider finding a potential buyer? It's a landscaping company. Thanks.
Oh, boy. These ones are fun ones. Honestly, I wish that this person would call the program so I could ask him additional questions, but it's not a very uncommon question where you just don't have the interest from the family. My son, he's got a finance degree, but he's undetermined whether or not financial advising is something he wants to do, or does he want to get in the tax world, and I understand that. So how do you find it? Well, for us, it was easy. Your best buyers are usually within the firm. The people that are motivated, the ones that are managing with you, the ones that understand the mission of the company, you find out ways to include them in the ownership over time. And ideas for this is you can have them buy shares. You can award them shares. If it's an LLC, you'll talk about them as membership interests. So you would award them pieces of that. And ownership is sticky. It is very sticky. It's a great way to keep somebody of value there. They become involved with the finances. They have to see the financial reports they get to, and they, of course, are going to earn dividends and so on. So it creates a good partnership, and you think, well, I'm going to lose control. You don't have to lose control. Remember the whole thing about the document being free form, and as long as everybody accepts it, it's generally legal in your state and federally, then you can put it in there. So you could write up an agreement where you're going to remain the manager for some period of time. You could put benchmarks saying sales need to stay here or above, or you're going to take it back, or whatever it's going to be. It's free form, and you can start working on it with your employees. Now, there are SBA programs out there where a minority shareholder can receive as much as 90% of the financing, or even 100%, and have it backed by the SBA working with the local lender to buy out the remaining shares, which could be preferential to the seller as well. Or maybe it's not. Maybe the seller wants to work out a multi-year deal where they carry the note and really consider the tax implications of each payment that comes in each year, and understanding that spreading it out could actually save them a ton of money. Then you think, well, what about the risk? Well, how about a structured note program? So there's lots of ways to work this in to the plan. There is a way to actually have the buyers put up the money and it goes into a trustee's hands. They manage it over a period of time and do the distributions over a number of years, let's say 10 years, and it changes the tax situation for the seller. The best place is usually within your company. And if you can't get a family member to take it, that's okay. I'm not a fan of nepotism. Honestly, somebody sitting around not earning a paycheck is not a person that I wanted to be on the payroll, and certainly not a part of the ownership pool. I want people that are motivated, and you just got to figure out creative ways to get them on board. And in many cases, their ability to come up with the cash is literally the reason why they're there being an employee. They don't have it. So you've got to figure out a way to be creative.
Yeah, I think creative is the way to nail it. And I would also argue it's like, okay, if your expectation was for one of your kids to take over the business and now that is essentially out of the equation, well, now you just reevaluate. Like, what do you want this business transition to look like? Like, and what's your timeline on doing this? Are you wanting to do this yesterday? Are you looking at a 5-year project? Like, meaning that once you really solve for my ideal transition scenario is this, and then maybe there's a dollar amount that's involved on that as well, then you can solve for, okay, based on that outcome, you can look at various routes to take. And if there's one thing that we know, I mean, there's a lot of consolidation right now with companies doing mergers and acquisitions. I mean, I don't care if you're a mom and pop veterinary shop, you're an auto repair shop, if you're a landscaping company. I mean, you're looking at a tremendous amount of momentum of people who want to buy businesses, or, you know, bigger companies that want to buy businesses. So I don't think you would have an issue finding a suitor. The question just really comes down to, how do you want that transition to look like? How much dollars do you need to receive from that as far as funding your retirement? Because if you own a company, you're collecting a paycheck and you're collecting maybe owner dividends, and then maybe the company's owning the truck that it's like all those benefits that you probably recognize for multiple decades. You got to be ready for what does that look like on the other side, and then how you structure the sale. What does that look like as well? And when you look at the numbers, it's kind of wild. I mean, I think this is going to be a common theme really over. I read this article where it said, I think there's about 6 million small businesses that are expected to change hands over the next decade. And which makes sense because I think you have over 20% of all U.S. businesses right now are owned by someone that's age 65 or older. So eventually these people are going to want to retire in some way, shape, or form. So I think this is I think it's a theme that's going to continue on really for the next decade where, and I think it's kind of cool because you're going to see a lot of people that are going to want to enter into entrepreneurship, meaning, and you have people that want to take these businesses over. So it's almost like it's like a good synergy there where you're going to have this people entering season of life, sell the business. You have people entering and taking over these businesses and becoming entrepreneurs. So I think on its own, it's a great thing. But to answer that question directly, you just got to see how you want this transition to happen. And by the way, we're going to have WR valuations on in a couple weeks, and we're really going to dive into how to get a business valuation and how to actually view your exit plan as a business owner. So I believe we're going to have him on August 1st. So if you're listening out there, you're a business owner and you want some insights on how to do that, we're going to have it on there. Again, phone lines are open 979-59-MONEY. That is 979-596-6639. We're going to go to the phone lines right now. We have Zany calling out of San Diego. Zany, what can we do for you?
Hi. Thank you. Hello?
Hello. Can you hear us?
How can we help you?
Yeah, I can
we hear
you
loud and clear. Hi, Zany. Perfect. What can we do for you?
My question that I told this call screener is I'm not rich, but I have 1.8 million that I have invested over the years that I worked. I'm a registered nurse specializing in surgery. And I invested it, I diversified it, but my question to you, sir, because that's your specialty, is how can I get some kind of growth with little risk so that I can adhere to the adage of little drops of water can make a mighty ocean. So growth without that much risk, because I invested it in IRA
and let's talk
Roth.
about that. I'll just change the analogy. Oh, I'm sorry. Go ahead, Zany.
I diversified.
Okay, I'm going to change the analogy.
Own,
I'm sorry. There's a little bit of a gap. That's on my part. The analogy that I would say is it's like adding drops to our buckets. So it's the same thing. We're waiting for the buckets to start to overflow. The reality is, Zany, is that $1.8 million is a lot of money, just maybe not a lot of money in San Diego, in your opinion. But understanding what that money would translate to when it comes to income has got to be the first step. They got to sit down with a qualified planner and start talking about these ideas, because you have worked for some time and you're retired now, right?
Yes, sir.
Okay. And are you taking a pension of any sort?
Yeah, I'm taking pension by required minimum distribution from my IRA, and last month or 2 months ago, for tax purposes, I reduced my RMD from my traditional IRA and got some from my Roth because of the tax freeness.
Okay,
and then I waited late to get my Social Security, so I have very good Social Security, and so I live on that one. This money is not really a formal source of existence. I just want to make sure that I bequeath it to my only daughter.
Yeah, Zany, you're answering all the questions that we would be asking to make sure that we can effectively arrive at what is really the purpose of that money. And Zany, real quick, that $1.8 million that you have invested, is that just between your retirement accounts, let's say your Roth and your traditional IRA?
And I also invested in an FIA.
Okay.
Put $500,000 there.
So Zany, if you look at your situation, you have this different categorization of taxation of your dollars. You have some in pre-tax, which obviously you mentioned is where you're getting your RMDs. You have some money in Roth, and then you have some money what you would deem as a non-qualified account. You're receiving Social Security, you got a pension, and you nailed it where you said you're not reliant on taking money out of these savings to sustain your lifestyle. So I think this answer is relatively easy, where if we want to maintain that balance between protection and growth, well, you've nailed it. You got cash flow. We got to make sure that you have liquidity. Now let's talk about how we can actually use the buckets to your advantage. Zany, if you can stay on the line, we got a break, hard break coming up. This is the Real Money Pros. We'll be right back.
Oh, thank you so much, sir.
Welcome back to the Real Money Pros. Again, phone lines are open, 979-59-money. You can send us a text message as well. That is 979-596-6639. We're going to go to the call. We're going to go to the phone lines right now. Zany, thank you for holding on during the break. And Zany, Brian and I were speaking like what a great job. I mean, you followed this to the T as far as this delayed gratification where you worked, you saved, you've amounted close to $2 million as far as liquid savings between your Roth, your traditional IRA. Sounds like you have a fixed indexed annuity, that FIA that you mentioned, which we certainly want to dive into. You're receiving Social Security, you have a pension as well, and you're not necessarily reliant on the liquid savings that you have accumulated to fund your lifestyle. Zane, let me ask you this. How long have you been retired for?
I retired in 2019.
2019. How do you feel about your retire? I mean, and you've seen some stuff happen between that time. Obviously, COVID took place. You've seen some various movements in the market. Have you, throughout that time, and you look at these close to 7 years of retirement, do you feel like quality of life is there? Do you feel like you're beholden to a level of budget, or do you feel like quality of life is good, pension, Social Security, and your liquid savings covers you?
I am happy and healthy, H&H, and my concern is not really concerned, but am I too conservative? I'm 60-40, and I wanted to delve into. I bought some few stocks of NVIDIA and REIT, the Realty Income.
Mm-hmm.
But I did not invest too much money because, first of all, I don't want to lose money. But I should have, but that's the hindsight. My major question is, my daughter is an only child. She's not married. And I'm almost 80, and when I die, I want to make sure that she is taken care of because she has no siblings. And that's why my main goal is to grow this money so that when I'm gone, she is not lost or left unattended or poor or homeless.
An effective, smooth transition of your estate to your daughter. Zany, do you have any type of estate planning in place, a will or a trust?
Yes, I have a revocable living trust that I need to talk to my state attorney to review if it needs to be updated or stay the course.
And you're tracking exactly right, where if we talk about the effective flow of your assets and your estate to your daughter, that trust, that living revocable trust, is going to be paramount. Making sure that it's updated, making sure that you have the right individuals involved. I mean, it sounds like it's going to be a relatively straightforward transition where you just want all of your assets to go directly to your daughter, correct?
Yeah, including my real estate. I live in San Diego, and my house, it's 1.6 million, I believe, plus minus. I'm not selling it. I'm bequeathing it to her because my belief is that the younger people may have difficulty. She worked as a private. She used to own restaurant in New York, and then the COVID, she moved it to Miami, and then her margins are not big. So now she is a private chef for the CEO of Ferrari, the NBA players, the FIFA, and next next assignment.
So I mean, which is great. I look at this because in some scenarios, I'm not a big fan of where a child is really expecting a large inheritance, which then really changes the trajectory of how they're living their life, and that doesn't seem like it's the case for your daughter. I mean, she a restaurant chef, and seems like she's rocking and rolling on her path and her career, which is fantastic. Zany, there's a couple things that you could look at with you being 80 years old. Obviously, making sure that your assets are properly titled to the trust. That will then ensure avoiding probate and effective transition of your assets to your daughter. And all of the assets that are not held in an IRA, those will get a step up in basis, meaning no tax implications to your daughter. So that's going to be first and foremost. Now, what you could consider is, I mean, Zany, you mentioned that you're happy and healthy, the 2 H's. I love to hear it. You could consider accelerated gifting, meaning if you wanted to essentially gift cash or maybe your highly appreciated stock, you could gift that to your daughter beforehand, meaning you could experience her that quality of life impact with that gifting of dollars while you're still alive. And you can gift up to $19,000 per person while avoiding a gift tax return. But to be clear, a gift tax return does not mean that your daughter's running into taxes or you're running into taxes. It just kind of keeps a tally of that. So that's certainly an option there. Zany, do you gift to any charities? Like, do you tithe to a church or anything of that nature?
Yes, I do, but not. I'm very frugal because I came from the rice paddies of Asia, and my mom I wanted to be a lawyer, but my mom said, be a nurse, you'll go to America. And I'm so glad I came to America. This is the best. You work hard here, you make it.
You're a living testament to the American dream. I mean, if you look at that move that you made, I mean, and I appreciate your service as a nurse. I mean, that is really, that servitude as far as a career that you can look back on, I'm sure you have an extreme amount of fulfillment. So you couple that with, your daughter who is, arguably on her own and successful and navigating life. And then you add on the fact that you did the right things, meaning the delayed gratification, deferring money. Now you got the Social Security, the pension that covers all your needs. So now you really get to arrive at these strategies with your amounted wealth of what's the best option. Now, Zany, to your point where you said, well, I don't want to lose it, but I also want the money to grow because I want to make sure that this money that's earmarked for my daughter, and you've experienced, Zany, like I would imagine that you've been invested along the entire duration as you've been adding money to these retirement accounts. So you've firsthand seen what the stock market or what the markets and investments can do for you. Am I tracking right there?
Yeah, when I first came to America, I was assisting in surgery. And all the doctors, they're all Jewish doctors in Philadelphia, and they were all talking about the investment. I listened, and I remembered, and that's where I started. In 1970, I invested in Prudential Securities. I still have it today. And I listened to the doctors, they're all Jewish in Philadelphia back then. And so I learned, and, patience, hard work. In time, my grass became a little milk. So
we need more people like you, Zany, and we appreciate this conversation too. And I would highly suggest you get a second look. I'll just sum it up.
Yeah, it's 1%. Yeah, it's 1% fee per million. Is that the norm, sir?
It seems, yes, it is probably the norm, and I don't think it's out of whack at all. But when you had said equity index annuity, I kind of had to tighten up a little bit. You've explained a little bit more your conservatism, which I think that may make that equity index annuity at least, I guess, well, maybe it's okay in there. The fact is that I would get a second look simply because you had mentioned that product, which is usually sold with a commission. And my concern is that maybe the advice that you've been giving has not been optimal for you, Zany, at all times. If you're willing to leave your number with our producer, we'll have somebody on your team, maybe Jeremiah, give you a call this week and at least get a second opinion is really what I would strongly suggest.
if the FIA, they say, I have experienced
Fixed
it because
index.
when the market tanks, I don't lose a dime, but I don't have much growth. But that I'm willing to take
you don't have
that,
any growth.
Fees and no growth.
You really
that could
don't
be
have
eating
any
at-
growth when you. Yeah, and I'm going to guess that money is sitting inside of a qualified account like an IRA or something that you're not going to get the tax benefits of the fixed indexed annuity.
Well,
Yeah.
that money
And so-
that I moved to FIA came from traditional IRA. So
Yep.
I guess I
There
read
we
and
go.
read that I have to take RMD from my FIA.
Yeah, RMDs, and the fact is you want that money left for inheritance, which probably means that you don't need it to be inside of that annuity product. This is Real Money Pros.